Tim Cook calling his tiff with David Einhorn a sideshow. Let's talk to Reuters' Fred Katayama, fellow anchor here. All right, Fred. Tim Cook talking today at a conference at Goldman Sachs, calling it a sideshow.
Yeah, Lisa, he's basically disputing David Einhorn's characterization of Apple as having a Depression-era mentality of hoarding all that cash, $137 billion cash pile, you know. But, you know, there you see Tim Cook there. Cook admitted that he called the proposal creative and said he is carefully considering Einhorn's proposal. Einhorn's proposal being the one. He sued Apple, but he's saying, come on, Apple, just put out more of your cash in the form of preferred dividends, preferred stocks that pay dividends.
Right. So Tim Cook, as you said, he's pointing out that he's saying, look, we are committed to giving money back to shareholders, whether we do it this way or some other way. That's there. We know we're sitting on a pile of cash.
Right. And the thing is, that pile of cash, how do you use it? Well, there are questions that came up during that Goldman Sachs conference. Among them, you know, what are you using that cash for? What about making big acquisitions? And Tim Cook basically said, we have been making acquisitions every other month on average, but small acquisitions.
That's right. He doesn't seem too worried about smartphone market share as well. Somebody asked him about that.
No, he's not, Lisa. And you know, a lot of analysts have been pointing out that the U.S. and Europe, the developed economies, that their smartphone sales are starting to mature. But Tim Cook says, hey, the market's still growing. In fact, it's expected to double over the next 4 years. So he says he's not worried.
All right, and also about cannibalization. He says we never think about cannibalization here at Apple. We brought in new customers with the iPad, and I'm guilty, I don't know about you, buying into their entire suite of products. Nothing's cannibalized so far for me.
And that's okay for Apple because there's that ecosystem. Okay, so you might buy something else of Apple. And besides that, was it Steve Jobs or someone who said, hey, if someone's going to kill my product, I'd rather cannibalize it myself than having someone else buy it.
All right, Fred, stay put. We're going to come back to you in just a minute. I'm going to be joined by Daniel Basis now. He is our Reuters global investment correspondent, and you are going to up-to-date us on this whole McGraw-Hill, Standard & Poor's, sort of a mess about the government suing them, and their earnings came out today, which were strong despite a loss, right?
Indeed. They are in the final stages of what they call their growth and value plan. It's a restructuring plan. They sold off an education unit for $2.5 billion to Apollo. They took a charge for that.
Yeah.
So let's look at it this way. Full year revenue, $4.45 billion, right? If the U.S. wins its case, is it successful and the U.S. gets whatever it wants, that's all gone. It's a $5 billion case, right?
But they're saying actually they don't think the government's going to find anything in this case, right? No intentional, there was no intentional misconduct, they're saying today.
No, and they're saying that, you know, even in 2007, in their report, right, it included the U.S. officials in 2007 publicly stating the problems in the subprime market appeared to be contained. Right. So if anybody got bamboozled, well, they all got bamboozled by the credit crisis. So here are the things to think about. A lower burden of proof in this civil case. The government accuses of S&P of reducing or keeping its ratings, you know, I guess inflated, right? And they're accusing them of fraud.
Right.
Proving that case is going to be a bit harder, but again, it's a civil case versus a criminal case.
Right.
So let's look at the earnings, right? 76% rise in continuing operations, that's excluding the education unit, right? Driven in large part from rising debt issuance. So what's happening in the world? We have low interest rates, we have low inflation, we have refinancings. People are looking to, you know, redeploy that cash, right? So they're going into the bond market. More bonds means more ratings. S&P is the largest of them all. So the net loss, right, because of that, yes, it does put a little bit of a line underneath their robust earnings, but the company's forecasting robust growth in 2013, looking at 310 to 320, 15% rise in their earnings per share in the coming year. So here's the question you got to ask, and I think you've got the graph up there. If the case is thrown out, or they have to pay a fine, or if maybe they risk losing their NRSRO designation, which gives them their kind of heft in the market.
Approval,
that's unlikely, right? You've got a 24% decline in the stock price since February 1st. That asks you have to ask the question: is that the mother of all short? Mother of all short coverings? I mean, do you have a pop in the price coming? The stock price is well below the peak in 2006. A dividend yield of 2.5%, right? So you have to ask yourself the question as an investor: if you're looking at savings accounts that have 0% interest, and you've got 2.5% stock price, you have to ask yourself, is this a buy or a sell at this point?
All right.
We'll have to see what happens.
Good to pose that. All right, Dan Basis, thank you so much for your insight there. I'm going to move back to the hot spot here, where I'm joined again by Fred Katayama. And Fred, we're going to talk Clearwire. Charlie Ergen, the billionaire over at Dish, he's saying, take this $2.3 billion with a B bid serious that I want to go into the wireless business here.
Yeah, he's saying this is not illusory. So he says he really wants it. He's offering $3.30 a share. That tops the $2.97 share that Sprint had already offered in a deal it had with Clearwire. And it's still not clear as to why he wants Clearwire. Some analysts speculate perhaps he wants to leverage in negotiations with Sprint over a network partnership.
That's right. All right, let's move on and talk about some hotspots here that are moving on. Hermes, luxury doing well between Michael Kors and Hermes. Hermes beat its own forecast, nearly 16.5% rise in 2012 sales.
Yeah, and these are expensive handbags this company sells.
I don't have any of them.
My wife doesn't have this. She wants it. $8,000, by the way, as I was looking online. But yeah, it's Q4. Its fourth quarter was so strong that it even beat its own upwardly revised forecast it had just revised upwards in November.
Right.
So it really even surprised itself. A lot of the strong sales coming from Asia. Not a surprise. They added 2 new stores in China and Taiwan.
All right, moving on to Michael Kors, because Michael Kors hit a new all-time high today of 64.80. I think down just a bit right now.
Stock up more than 11%.
Yeah, exactly. They just keep rolling along, Michael Kors. More good news for this company.
They are on fire. Yeah. And their handbags, by the way, a lot cheaper, $200 that I looked online at Macy's. But it's affordable luxury.
Right.
It's doing what Coach used to do.
Right.
And the stock is really hot. The company, it's doing so well that it quadrupled its profit to $130 million. And it crushed analyst estimates by more than 50%. It's upping its estimates full year to $1.80, $1.82 a share, well past Wall Street's expectations of $1.57 a share. It is really doing well, converting its department store locations into shop within shops.
Right, awesome. All right, Fred, thanks so much for being with us. Remember, folks.
And I can afford that as a present to my wife.
Yes. Can you get me one too?
Valentine's?
I think your wife might not be happy about that. Well, keep it for your wife. All right. Follow us on Twitter at Reuters Insider. And remember, follow more great videos that we put out at Reuters.com/ReutersTV. I'm Lisa Bernhard, and this is Reuters.